Hi, let's continue our conversation about valuation of assets. And this topic is about valuation of stocks. And we are going to discuss valuation of preferred stocks first and then valuation of common stocks. For the preferred stocks, if you recall from chapter 2 when we reviewed the financial statements, if you are a preferred stockholder, then you are paid fixed dividends, then you have no binding contractual obligation of interest on debt. That's going to be for common stockholders, and does not have, if you don't have ownership privilege of common stocks, which means you are not going to be able to vote, no voting privilege. And also there are legal provisions that could be enforced. You don't have any legal provisions that could be enforced on that. For example, if the company loses money and you are not, you don't have this provision that you are liable for that. So for the preferred stock, let's think about that. What's the difference between a stock as an asset and a bond? For the bond, our previous discussion, there is a time to maturity. There are two types of payments for the investor. One is coupon payment, and then you receive your principal or face value back. Now here, there is no time to maturity. There is no principal. The only payment that a stockholder, in this case preferred stockholders, receives is the dividends, annual dividends. So it functions in a different way. It's a different type of assets. So when it comes to calculating the price of this preferred stock, we have to be able to calculate the present value of all future dividends. The problem is that we don't know when it ends, because even if you sell this stock, somebody else owns it, it's not going away. So it's going to become more complicated, because you see, we have to calculate the present value of basically an infinite dividend payments going into the future. Present value this year, next year, third year, and so forth. So price of the preferred stock is the present value of all these future dividends, which are equal. You see, dividend payment is equal, doesn't change. And this formula, there is a mathematical way to transform, to approximate this formula into this one, and that's the one we are going to use. Luckily, it looks much easier than this one. So to calculate present value or the price of the preferred stock, we use the dividend payment, annual dividend payment, and this is the required rate of return or discount rate. So for a practical example, if you have 10% annual dividend for a share of stock, and that's the required rate of return, then the price of the stock is $100. So that's one calculation. Then if we change different variables, then of course the numbers are going to change. For example, here, assume the required rate of return increases from 10% to 12% here. You still receive $10 dividend payment, that's fixed dividend. So now the price of the stock is going to go down. It's the same relationship as we discussed in bond valuation. When the yield goes up, the price goes down. Okay? Now that's the opposite case. When the yield goes down, goes from 10 to 8 down, then the price is going to go up. So here we have, and that's the general formula for the price of preferred stock. And then of course sometimes you want to calculate what is the required rate of return for different stock payments, dividends, and prices, for different prices that stocks have. And then you have to invert this formula here. That's the original formula. So to calculate that, you divide the dividend by the price, and this is the required rate of return. Now, if you ask for a price to buy some preferred stock, and if the price goes up, you still make $10 the fixed dividend for that stock. So that means that your the required rate of return or yield goes down. Okay, so that was the discussion of, that's the only formula we are going to use. And now depends what the problem asks us. We can invert this formula, replace the variables. For the common stocks, now we are going to move in the discussion of valuation of common stock. The common stock here, we have common stockholders. They can have different type of dividends payments. They have voting rights. They can grow their dividends if the company grows. So as a stock, as an asset, it functions similar way. They still receive dividends, but the dividends are not necessarily fixed unless there is a constant growth in dividends. More common, there are variable dividends payments, which can be constant growth or variable growth in dividends. The first case we have, so we have here the formula, present value of different dividends. You see they are not necessarily the same, but the general formula is the same, present value of all future payments of dividends. Okay, and they can be no growth in dividends. That would be the same as preferred stock payments. Constant growth in dividends, every year they grow by 2, 3, 4%. Variable growth in dividends, which more complex calculations. So the first case, valuation of common common stocks with no growth in dividends. We have it's basically the same formula that we had for preferred stock dividends calculations of price. They use different notations just because it refers to common stocks rather than preferred stocks, but the calculation, the mathematical calculation is the same. So we use this time P0 for the price of common stock, D1 dividend for the no growth dividends. So they are going to stay the same, and that's the required rate of return. And if we have a dividend of $1.87 and required rate of return is 12%, that's going to be the price of the stock. Now, most common is actually the next case, constant growth in dividends. So suppose that your dividends are going to increase by a percentage. This G is growth in dividends. It can be any percentage, 1 or 2% a year. Then you see they are going to grow by this amount every year. So we calculate present value of future payments, including the growth of dividends. And we start with original point and then we go from there. You see here 187, we apply 7% growth rate. We have first year dividends 2%, now again 7%, and it's increasing in the future. And then we have to calculate the present value of all these future payments. Well, again, instead of using this complex formula, math helps us with an approximation of that formula. That's the one we are going to use in applications. Price of the common stock. We start with dividend at the end of the first year, divided by required rate of return minus growth of dividends. Excuse me. So now, given that we have 7% growth rate, using the formula here, we calculate a price of $40.